Cryptocurrency trading can be both exciting and challenging. How can you make informed decisions to maximize your profits? In today's video, we're going to delve into the fascinating world of technical analysis and discover how it can be a powerful tool for cryptocurrency trading. We'll break down essential tools, strategies, and tips that will guide you through the ups and downs of the unpredictable crypto market. Whether you're new to trading or looking to refine your skills, this exploration will offer practical insights to help you make informed decisions and feel more confident in your trades. Let's jump in and unlock the secrets to navigating this exciting and dynamic financial landscape. But before we continue, we would like you guys to subscribe to the channel, like this video, and hit the notification bell icon so you do not miss out on any amazing and entertaining content. Also, for more updates, be sure to visit our website regularly at cryptogalorenews.live and follow us on Instagram at cryptonewsgalore. Understanding technical analysis. Technical analysis involves studying price charts and using various tools to predict future market movements. Unlike fundamental analysis, which looks at the intrinsic value of an asset, technical analysis focuses solely on historical price data and trading volumes. By identifying patterns and trends, traders can make educated guesses about where the market is heading. This method is widely used in cryptocurrency trading due to its volatile nature and the availability of extensive historical data. The basic assumption of technical analysis is that all relevant information is already reflected in the asset's price, and studying these patterns can provide insights into future price movements. Key chart patterns. Chart patterns are formations created by the price movements of an asset. Recognizing these patterns can provide valuable insights into future price action. Some common chart patterns include head and shoulders, double tops and bottoms, and triangles. Each pattern has specific characteristics and implications for future price movements. Traders often use software and online platforms that highlight these patterns automatically. Once a pattern is identified, traders can use it to set entry and exit points for their trades, making their strategies more precise and informed. Using moving averages. Moving averages are one of the simplest yet most effective tools in technical analysis. A moving average smooths out price data to create a single flowing line, making it easier to identify trends. There are two main types of moving averages: simple moving averages, SMA, and exponential moving averages, EMA. SMAs calculate the average price over a specific period, while EMAs give more weight to recent prices, making them more responsive to new information. Traders use moving averages to identify the direction of the trend and potential reversal points. Relative Strength Index, RSI. The Relative Strength Index, RSI, is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is used to identify overbought or oversold conditions in the market. An RSI above 70 suggests that an asset is overbought and might be due for a correction, while an RSI below 30 indicates that an asset is oversold and could be due for a rebound. Traders use the RSI to spot potential reversal points and to confirm trends. For example, if the RSI moves from below 30 to above 30, it can be a sign that the asset is gaining strength and a buying opportunity might be present. Conversely, if the RSI falls from above 70 to below 70, it could indicate that the asset is losing momentum and a selling opportunity might be approaching. Bollinger Bands. Bollinger Bands consist of a middle band, usually a simple moving average, and two outer bands that represent standard deviations from the middle band. These bands expand and contract based on market volatility. When the price moves close to the upper band, it indicates that the asset may be overbought, while a move towards the lower band suggests it may be oversold. Traders use Bollinger Bands to identify potential reversal points and to gauge market volatility. A common strategy involves looking for price movements outside of the bands. When the price breaks above the upper band, it could be a signal to sell, while a break below the lower band might be a signal to buy. Support and resistance levels. Support and resistance levels are key concepts in technical analysis. Support refers to a price level where an asset tends to find buying interest, preventing it from falling further. Resistance, on the other hand, is a price level where selling interest is strong enough to prevent the price from rising further. These levels are identified by looking at historical price data and finding points where the price has repeatedly reversed direction. Traders use support and resistance levels to set entry and exit points for their trades. Buying near support levels and selling near resistance levels can be an effective strategy. Additionally, when the price breaks through a support or resistance level, it often leads to significant price movements. Volume analysis. Volume analysis is a crucial aspect of technical analysis that examines the quantity of an asset traded during a specific time period. Higher trading volumes often indicate strong investor interest and can confirm trends. For instance, if a cryptocurrency is experiencing a price increase accompanied by high trading volume, it suggests that the trend is strong and likely to continue. Conversely, low trading volume during a price increase might indicate a weak trend that could reverse. Volume analysis can also help identify potential reversals. For example, a sudden spike in volume after a prolonged price decline might indicate that selling pressure is easing and a reversal could be imminent. Candlestick patterns. Candlestick patterns are a popular tool in technical analysis due to their ability to convey a lot of information about price movements in a compact format. Each candlestick represents a specific time period and displays the opening, closing, high, and low prices. There are numerous candlestick patterns, each with its own implications. For example, a doji pattern, where the opening and closing prices are very close, suggests indecision in the market and potential reversal. A hammer pattern, characterized by a long lower shadow and small body, indicates that sellers pushed the price down during the period, but buyers managed to bring it back up, signaling potential bullish reversal. Fibonacci retracement. Fibonacci retracement is a technical analysis tool based on the idea that markets will retrace a predictable portion of a move, after which they will continue in the original direction. The key levels used in Fibonacci retracement are derived from the Fibonacci sequence: 23.6%, 38.2%, 50%, 61.8%, and 100%. Traders use these levels to identify potential support and resistance areas. For example, if the price of a cryptocurrency is rising, traders might look for a retracement to the 38.2% level as a potential buying opportunity. Similarly, during a downtrend, the 61.8% level might serve as a resistance point. MACD, Moving Average Convergence Divergence. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of an asset's price. It consists of two lines, the MACD line and the signal line. When the MACD line crosses above the signal line, it generates a bullish signal, indicating that it might be a good time to buy. Conversely, when the MACD line crosses below the signal line, it generates a bearish signal, suggesting that it might be a good time to sell. The distance between the MACD line and the signal line also indicates the strength of the trend. Mastering technical analysis for cryptocurrency trading requires time, practice, and continuous learning. By utilizing tools such as chart patterns, moving averages, RSI, Bollinger Bands, volume analysis, candlestick patterns, Fibonacci retracement, MACD, and effective risk management strategies, you can enhance your trading decisions and increase your chances of success. Stay disciplined, keep learning, and always adapt to the ever-changing market conditions. Thank you for watching our detailed guide on how to use technical analysis for cryptocurrency trading. If you found this video helpful, please give it a like and subscribe to our channel for more insightful content. Don't forget to visit our website at cryptogalorenews.live for additional resources, and follow us on Instagram at cryptonewsgalore for updates and the latest news. See you in the next video.